Welcome back to this month's edition of CAP STRAT Wealth. Lots to share with you today. As always, we're going to start with some quick updates, but then we're going to jump into some tax law changes that are coming down the road here in 2026. So we'll dive into that here in a second. So just a couple quick updates. October 15th is the extension deadline for personal tax returns. Hopefully if you are on extension, you have this almost completed. By the time this video is released, it's probably going to be pretty close to that. So certainly that also ties into our annual review process. This is important because we want to take a look at your tax return. So once that's completed, be sure to send your tax return to us, as we want to build that into our modeling system as we're in full force for our year-end planning meetings. So if you don't have that scheduled yet, look forward to getting that on the calendar here to make sure we have plenty of time to review before 12/31. And then the final update just regards to the Bright Start 529 plans. A lot of clients have exposure, especially within the state of Illinois, to this plan. That completed its transition over to TIAA. So now is the time to go out and establish your new username and password. You can do that directly through the Bright Start Direct website, and certainly make sure you take a look at your balances and establish that as soon as possible. We'll be having conversations through our year-end planning process to make sure we relink that to the financial planning software, but certainly more to come there. And if you have questions, reach out to us, and we're happy to address that. So let's jump into our main topic here, which is really focused around taxes. Back in 2017 is when the Tax Cuts and Jobs Act went through. Call that in the similar terms of TCJA. Yep. We'll see that referenced here throughout the conversation. But this is important because that was implemented in 2017 and it was scheduled to sunset here at the end of 2025, starting in 2026. So we're going to focus on a couple items here today. Obviously, this is a very broad topic and there's a lot thrown into that original bill. So we're going to focus on just a handful of topics that we would encourage to look at. But the bottom line is, we don't know exactly what's going to change. There's obviously going to be a lot of political conversations going on in regards to this topic. We'll see who is the ultimate president at the end of the day, which also might drive some of these outcomes. So lots to change here, but certainly we want to bring this to light, bring it to your attention, because these are a lot of the conversations we're also having to try to plan for the end of the Jobs Act that is scheduled to go through here. So why don't you kick it off here, Mike?
Great. Thanks, Neil. And again, as you mentioned, our whole goal is to give all the viewers some practical examples of what is going to change and really just focus on how it's going to impact you and your family and your wealth and ultimately, your taxes, not only now, but how we plan for those down the road with the known of right now this is scheduled to sunset, but as you mentioned, could very well change. So if we really distill it down, there's four main areas that we want to spend some time on today. The one that gets the most attention is the marginal income tax brackets will change. Just figured it's helpful to show a visual, think back, almost 6-7 years ago now, of where were you at that point and what changed and what do you remember changing on your taxable profile when these old brackets were in effect, because these are scheduled to go back into effect in 2026. And you can sort by single or married filing joint. Compared to where the 2024 tax brackets are today, 5 of those 7 brackets will actually adjust upwards, or for 5 of those 7 brackets, that marginal tax rate will increase. There will also be some changes to income deductions and credits. The one that gets the most popularity there is the standard deduction, which currently the majority of Americans, almost 90%, actually file the standard deduction under the current TCJA tax law. That is scheduled to be cut in about half. So there's going to be some significant changes there depending on the size of your family, the amount of state and local taxes you pay, the state that you live in that's driving those taxes, and we'll talk about that as well. Also, the alternative minimum tax, the thresholds for those are set to lower, so that could impact probably a smaller amount of Americans, but depending on where you're at in the brackets, there's a higher chance that you might be subjective to the alternative minimum tax. And then last but not least, the federal state tax limit. I know everybody's favorite subjects, death and taxes, but otherwise known as the death tax. That federal limit is set to cut in about half. Adjusted for inflation right now, it's about 13 million, but it will cut to about 7 million in 2026. That's a a long way of saying, if you have a taxable estate of upwards of $7 million in 2026, then there's likely some need for some estate planning, as that will change your taxable profile.
Deductions. It's always a fun topic.
Yes.
Did you hit on this one?
Yeah, so this is where, again, this is going to vary significantly between individuals and families. But again, that headline number of the standard deduction, which 90% of Americans are taking advantage of today, that has increased significantly, that's going to be scheduled to be cut nearly in half.
Right.
And then you filter in the other versions of deductions, like personal exemptions, child tax credits, and then everybody's favorite, the SALT, or state and local tax deduction as well. And that cap is set to expire at the end of 2026.
Yeah. So I guess to that point, and be more specific, like if you think about state and local income taxes, like real estate taxes, right? That was all capped at $10,000, and essentially that cap's going to be lifted. So that definitely can be a benefit to some people, just based on their tax profile. But that also might bring back into that conversation of AMT. Right. Is that going to potentially dilute their ability on those dilute those deductions that they have out there?
So if I'm a client, Neil, and I'm either in a state like Florida or a state like New York, how is that SALT, cap sunsetting going to affect me differently?
Yeah, the state tax portion is substantial.
Yep.
You could be paying easily 10+% in the state of New York, where ultimately in the state of Florida, it's zero. Right. So that's definitely a factor that's going to come into play, and will be an important side-by-side calculation to understand, if it's going to help you or not. So as we think about 2026, what are some things that you should be considering, or at least evaluating before then?
Yeah. If there's opportunities, depending, what your income is now, versus what you're expecting in 2026, whether there's going to be additions of Social Security, RMDs, et cetera. If there's an ability to accelerate some income realization, even for executives with stock options, for example, if the planning shows that your taxes are set to increase once those sunset, it's worth maybe considering accelerating now while we still have those lower marginal income brackets, especially at the upper tiers in the high 20s and 30s as well.
Some of the things I think about that are on the screen too is think about Roth conversions. This is certainly tied to that, even the executive planning as well. But if you are going to be in a higher tax bracket, especially when you are taking out your required minimum distributions at age 73 or 75, and you can do some proactive planning today to have lower distributions down the road, that's something you want to consider. The opportunity here is if you can convert at, say, that 24% tax rate and avoid a potential 30, 35, or even 37% tax rate, that's something you want to evaluate today, even before some of those adjustments are made to the tax brackets.
And going back to deductions, one of the planning items, if more Americans are going to not be able to do the standard deduction once it sunsets and cuts in half, what deductions are you able to essentially claim or try to plan that you could take to be able to itemize and reduce your taxable income once everything sunsets in 2026? Find a lot of clients who are making charitable contributions and donations today. There's a chance and a use case to be made for, do you potentially hold off if there's no commitment in the next 2 to 3 years and potentially stack or bunch those charitable donations in 2026 and be able to itemize a higher portion of those charitable contributions? And last but not least, estate planning. I know we touched on this. There's the basic estate planning documents that we believe strongly in, and then there's the more advanced estate planning strategies. Again, especially if you have that taxable estate. And we know today the threshold is anything almost over 13 million. But as that cuts in half, that's going to affect more Americans, and the individuals and families that we work with. Yeah. And that's something to be aware of, if something were to happen, what is that taxable estate? And, do you want to plan for that, with advanced estate planning, or do you want, anywhere between 18 and 40% of that to be taxed and paid to the government once that limit increases?
Yeah. And that's going to come down to an individualized conversation, depending on not only the scope of your wealth today, but really your objectives, right? You never want to give away money that you ultimately will need, and there are some advanced strategies that can be considered just in those discussions that we can certainly talk about in more of a one-on-one conversation. So, but these are all topics we want to encourage you to be thinking about. And what I think about too is like in 2017 versus where a lot of clients and people are today. Before they were working.
Yep.
Now they might be retired. Their overall this expiring bill that's going to be coming down in 2026 is going to look completely different than where it was in 2017-ish, 2016 to where you're at right now. So it'll be interesting, and I think that comes down to as we think about how we can help. It's really just being proactive on these conversations and evaluating all these different strategies that are out there today, and really what fits into your profile, your objectives, and what's going to make the most sense for your personal financial wealth. And as we always say, we're not the ones with all the answers, but we want to be kind of helping to drive the bus there, and ultimately bring in the appropriate parties, whether it's your estate planner or whether it's your tax advisor and CPA. That's where we want to be an advocate for you to make sure that you have all of the important team members at play and making some good decisions before the expiration of these tax cuts. So that concludes our conversation here today. Certainly reach out to us if you have any immediate questions, but we'll be having more of these conversations in the year-end discussions, and we'll see you soon. Thanks so much. Bye-bye.